Hey there, everyone. Welcome to my channel. My name is Ryan Schul. I talk all about data science, machine learning, deep learning, artificial intelligence, and things related to this. Okay. So a lot of my teaching lessons tend to be about finance. I got my MBA in finance about 2 decades ago, and it's been on Wall Street pretty much my whole career. So I know the stuff pretty well. Sometimes I deviate from finance, though, and discuss other topics. I like things like latitude, longitude, coordinate plotting and optimization and things like this. So sometimes I'll get out of the finance domain a little bit, but today I'm going to focus specifically on finance, and we're going to look at stock options and understand how we can go ahead and do options pricing, and then how can we find the best options given all the options that are out there. Okay, and it gets a little bit convoluted, it gets a little bit complicated. I'm not going to I'm not gonna lie about that part. It took me probably the better part of a week to put this whole thing together, to do all the research and analysis and coding and debugging and get everything structured and organized and working in a logical fashion. So it did take a while. This is probably one of my more complicated videos, but I think it's very interesting too. And I think you're going to learn a lot if you stick with it to the end. So basically, options prices are influenced by several different things. Of course, the underlying instrument that it's attached to. But let me take a step back just for a moment. What is a stock option? It's an option to buy a contract. It can be a call or it can be a put contract. If you buy a contract and it's a call, you want the stock to go up in value and appreciate in value. And if you want to buy a put, you expect the stock to go down in value. So there's two main reasons why a person would do this, or maybe a company would do it. Basically, to try to generate profit, okay, on the volatility of a stock, either up or down, it doesn't matter, or to protect yourself, right? So it actually acts as an insurance, as well, not direct insurance, but a form of insurance and hedge and a type of protection. If you own an asset and the price depreciates, you're going to lose money, right? But if you buy some puts and the price of the asset will depreciate, but you'll make some money on the put, right? On a put contract, because puts are more valuable when the stock goes down. So you can offset your losses with the put, right? And the call is just the opposite. You can sell a call or buy a call. You can sell a call or, I mean, you can sell a put or buy a put. It gets pretty complicated. So if you know this stuff pretty well, congrats to you. That's fantastic. If you don't know this stuff, you're probably going to have to do a little bit of research. I mean, I know it pretty well. I had to do a ton of research to get up to this point. But anyways, it's pretty fun. And if you get good at this stuff, you can make a lot of money trading options too. You have to be careful. You can lose some money on these things too, right? So let me take you through my findings and show you how all this stuff works. And I'll share my insights with you. Basically, the steps for options analysis includes retrieving data from some source. We're going to use Yahoo Finance. And the way I set this up is you just enter a stock ticker. So it's going to be a symbol. It could be 1, 2, 3, 4 letters. And that's it. You can pick any symbol that you want as long as it's available on Yahoo Finance. You can go fetch the data, pull it back, as long as they have options. Not every single stock out there has an option contract traded on it, but as long as they have the options, you can get everything from Yahoo Finance. We can estimate the probability of profit. I'll show you how to do that. We can understand the volatility of the underlying instrument and how that impacts the options price itself, right? So remember, the option is a contract, either a call or a put, where you can expect the stock price to go up or down, and you want to, if you guess the right direction, you can generate a huge profit for yourself, right? Or you can create a form of insurance for yourself as well, right? So we'll discuss that. So let me show you some of the equations here that go into this thing. This is kind of a beast, so you have to kind of be prepared for this one. All right, this is easily the most difficult video that I've done to date. So the Black-Scholes formula for a call option looks like this, okay? And they break it down for you, so it's not too bad. I mean, you can look at this and figure it out. And there's all kinds of other resources how you can derive how this equation works, and you see the function right here itself, and then you see all the variables in the definition. So C is the price of the call, S is current stock price, so that's the underlying instrument that the call or the put is written on. In this case, it's a call. We have the K, that's the strike price, the risk-free interest rate, the time to expiration, that's the theta, and then Euler's number, and then we have a few more functions down here, okay? So I'll let you chew on that for a little while and digest that. And it's not easy. It's not easy, okay? So if you struggle a little bit, that's fine. I struggled with it, and I know this stuff kind of well, but I'm not an options expert by any means. But if you do spend some time on it, you can get up to speed pretty quickly, okay? So that's the sort of the inspiration and the motivation for what we're doing here, okay? So this is all captured in these functions right here. So when we start off, I replicated the formula that you saw down there. So we have the theta, the K, the sigma, the underlying instruments, the call and the puts, right? Because it's two sides of these contracts. The call contracts, again, you want the stock price to go up or appreciate, and the put you want it to go down. But that's again, that's only true if you're long the call or the put. If you short it, then you want the underlying to go in the opposite direction. Okay, so it gets complicated, guys. It's kind of hilarious how funny or how complex this stuff is. But if you get good at it and you master it, you can actually make a lot of money in the stock market or protect your valuable interest in whatever financial assets you own. So I think it is worthwhile to learn this stuff and to kind of understand the all the inputs here and the outputs too, right? So I really did all the work for you, so you don't have to do a whole lot. Copy and paste the code and run this in your own Jupyter notebook, and I will share this code with you when I'm done with the video. I'll post the video and I'll post the code. Save and export notebook as HTML. So you will have a nice HTML file with all the code in the file. So all you have to do is copy and paste, okay? So I went through this pretty extensively. I don't think there's any bugs whatsoever. I think the code is fully functioning and it functions correct as far as I can tell. If you do notice an issue or a calculation error or something like that, please bring it to my attention, post it in the comments, and I will look into it and make any and all necessary revisions. But again, as far as I know at this point, I tested it pretty thoroughly. I think everything's fine, but it is kind of a convoluted process over here. You can see, right? So there could be a mistake, but again, I doubt it. I don't think so. So those are the functions to do all the calculations. Then we will need our standard Yahoo Finance library. So I call that, I import that right at the top of the code here. SciPy stats to do some basic statistics, Plotly to do the plotting, and we're using some pandas functions down here to go ahead and handle the way that the data is displayed in a couple of different data frames, okay? So you saw the function above. Again, it should be all debugged and working fine. If you see an issue, let me know. And that comes from over here, right? And, oh, let me get rid of that. That's the HTML. I'll download that later. That's fine. So where does the data actually come from? It comes from Yahoo Finance, and this is what the list of all the call contracts look like, right? So you look at this thing and you say, oh my goodness, what is this? What is going on here, right? There's really a lot. So let me go over to Microsoft. This is actually Microsoft. I was looking at Apple earlier, but I switched over to Microsoft for the actual coding, live coding session. MSFT, is that it? I think so. Oh, Microsoft. Okay, and we'll look at the same options over here. Okay, let that run. But the look and the feel of this thing is going to be pretty similar to Apple, right? It's just written on the contracts are written on a different underlying instrument. It's on Microsoft stock instead of Apple stock, right? So this is what the list of all the calls look like. If you look really closely in the middle here, you'll see a C. That's how we know it's a call. That's identified by that C letter right in the middle of there. You have the last trade date, the strike price, the last price. You have the current price of Microsoft's right here. Okay, so 387 and some change. The bid that he asked. The bid is if you want to buy it, that's what you'll pay, and the ask price is a little bit higher. That's what it's selling for, and I believe the market maker keeps the difference between those. So the bid and the ask will never be the same. I think that's how the market maker actually makes his or her money, by the spread between those. Okay, so that's my understanding of it. I've never been a market maker, but that's why the bid and ask will never be equal, right? Because somebody has to make some money somehow when they do this transaction for you. That's how they get paid, okay? So then you have the change, the percent change, the volume of contracts, open interest, and the implied volatility. So 78%, that's pretty volatile. This is a little bit less volatile. This has zero volatility. This is 61%, and so on and so forth. So that's how we're getting our call data. You scroll down here, and at the bottom, you'll see the puts. So it's the same thing again. If you're long these contracts and you have a call, you want the stock to go up and appreciate in value, you'll make money. If you have a put, you want to decrease. But again, if you're short these contracts, if you sell it, you want the opposite. So if you short a call, you want the stock to go down. It's equal to, it's almost the same thing as buying a put. There's a small difference. I forgot what. I don't know. You can Google that. But if you short a call, you want the stock to go down. If you short a put, you want the stock to go up. Okay. I don't know what the technical difference is between those, but it's got to be something, right? Otherwise, why would they have opposing shorts and calls? So there must be some reason for that. But I think they're fairly similar for the most part. So here's the functions that do all the lifting for us. All the calculations are described right there with my notes as well. So this is how we pull in the data. Okay, let me refresh this. I'll run this so you can see how everything functions in real time. The functions actually calculate very quickly here. So that is going to, oh, is it even going? Let's see a little asterisk. I think it's fine. Okay. So refresh that just to make sure everything is up to date and in memory here. So the first thing I'm going to do is pull in the options chain, and I'm going to get all the calls and all the puts and append everything into a master data frame. Okay, so when I run this, it goes on to Yahoo Finance, fetches all the data, retrieves it into my Jupyter notebook, and then puts it into a nicely structured data frame so we can do some analysis on the options chains, the calls and puts, and start to do some pricing, and then figure out which are the best calls and the best puts. Remember, that's the objective here. So when I look at this thing right here, let me flip back to that other view. When I look at this, these are a lot of puts, okay? I don't even know how many are in here. Let me see. If I just copy and paste it into Excel, this is pretty quick, okay? So let me copy 80 something, I'm guessing, 80, 90 contracts. Okay, where's my Excel? Right there. Okay, so I'm just curious to see how many there are. Okay, and Excel is starting up, I think. I hope. Maybe. Maybe it's not. Okay. Maybe it's not. We'll give it a second. This computer's getting kind of old at this point, so I think kind of on the way out pretty soon. But you can see, anyways, you can see what this is right here, 387.82. That is the current stock price right there. And I think Excel is actually running because it's giving me a black screen right now. That's nice. Gotta love it. Gotta love the black screen. And I'm going to skip the Excel thing. The computer's getting kind of old, and some things just fundamentally don't work the way they used to work. Anyways, so when we look at this options contract, that's where all the data is sourced from. It comes from Yahoo Finance, right? And all the calls are going to be listed at the top. All the puts are going to be at the bottom, right? And if you look very close, you can identify all the calls with this little symbol right here. There's a C for a call, and there's a P for a put, okay? And the rest of the information in this identifier over here tells you about the stock. There's Microsoft, there's details about the contract, last trade date, strike, last price, bid ask, change, percent change, and so on and so forth, just like we did before. I guess my Excel just fundamentally isn't working here, and that's fine. I want to count how many contracts we have. I have about 313. About half, give or take about half, will be calls, half will be puts. So maybe 150-ish, 155 calls and puts. And my point, before Excel got me distracted here, is if you or I or your best friend or whatever starts looking at 150 call contracts and at 150 put contracts, are you going to be able to identify which one is the best and which one has the highest probability to generate a profit for you as an investor? Probably not, right? 150 contracts is a lot. you have to understand the strike price, the bid and ask. You have to understand the implied volatility. Is the stock in the money? That means if you exercise this option contract right now, you will profit because the stock is in the money. So the calls have to be above the strike price to be in the money, and the puts have to be below the strike price to be in the money, right? So we can see they're in the money, but also like what's the probability of the payoff? You can't tell from this view. That's impossible, right? And how much money can you potentially make when you exercise your contract? You can't tell that from this view, right? So that's what the whole point of this analysis is, to understand basically how puts and calls work and how options contracts work, but also to pick the best one. You're looking for a needle in the haystack, right? You have 150 contracts at least right here. I'm going to show you how to find the best 1, 2, 3, 5. I think it's 5. You do 1 or 2. But just from this view, it's impossible to know that, right? So we have to do some analysis and run these calculations that we saw above, run these functions, right? And use that as leverage to be able to figure out which contracts are the most lucrative and which ones are the most profitable, okay? So that's the whole point of this exercise. So I went ahead and pulled in the information. You can see this is Microsoft. Here's the ticker, MSFT. And what I really like about this tool is you can use this for any stock, right? So for Amazon, for Walmart, for Verizon, for Visa, obviously Microsoft, any stock that has options on the stock. And again, not all of them do, but a lot of them do. All the big companies do have these options. So any company, you can put in the ticker here, and you'll get all the options data and all the pricing. And then the final recommendation is which one should you buy. I'll show you how to do that in just a few minutes. So we have to calculate a few things. Some things are given to us, okay? But some things we have to derive ourselves. So we have the time to expiration. That's the time to expiry, just short for expiration, right? If you look really close here, where is it? Oh, you know, I think that's actually in the next view. I think that one was in the next view. Okay, so they don't even give you that, right? So you have to calculate that yourself. If you look at the original source data, so you don't even know. Okay, I know when this is actually expiring, because you have the date over here. So you'd have to pick the correct date. The closest one is March 21st. Right now it's March 18th. No, March 19th. It's March 19th. So in 2 days, this is going to expire. I think this is always on the third Friday. I think that's how they do it. And let's see. If I go down here to my little calendar, 2021. That is 2 days away, and I think that's going to be the third Friday of the month. Okay, so I think that's when these things expire. Okay, the calculator doesn't work, or the calendar doesn't work, and Excel doesn't work, so we'll just skip that. No, it's working. Okay, so 1, 2, 3, yeah, 7/14/21. So that is the third. That is the third Friday. So that's when these things are going to expire. And the point is, it's pretty close, right? So the time to expiration, or just kind of abbreviate it here, or just come up with a cool convention. Let's say expiration, expiry. The time to expiry is actually very short, because we only have like 3 days, right? Today is the 19th. By the 21st, this contract is going to expire. And right now it's later in the afternoon, so the trading is all done for today. You only have 2 more days. And I don't even know if the contract even trades in the afternoon on Friday, or if they finish up early in the morning. But by the time you get to Friday, you basically have no time left, right? So the time to expiration will be very short. The implied volatility is going to be pretty short too, because you only have a few days before expiration for these contracts, right? But if you pick a longer maturity date, you can pick all of your dates over here. Here's March 28th, right? So that would be the next week, right? So that would be the 4th Friday of the month, right? If that is the 21st is this coming Friday, and then April 4th, and then April 11th, and April 17th. Let me look at this quick. I think I might have made a mistake, because I thought it was always the 3rd Friday. But then if we go down here to April, let me see April here, 4th, 11, 18, 25, 4, 11, 17, 25. Okay, so they have all kinds of different expiration dates. So that's fine. You know, it is what it is. I don't even care about the expiration date. I'm just trying to demonstrate that The volatility will be less when you get closer to the expiration date because you don't have that much time to do anything. The stock is not going to make a huge move in 1 or 2 days, right? So if you have a longer time to expiration or the maturity of the contract, it's really expiration, but it's kind of like maturity. Then you have more implied volatility. If you have less time, then there's less volatility, right? So this is important to calculate the implied vol. We also want the delta, the theta, and the Vega, and we want to calculate each of these because none of these are given to us. If you look at the original data, let me go to the most recent date here, or the closest date. So that's March 21st, right? So that's 2 days out, basically two trading days because it's at the end of the day on Wednesday. So you have the contract name, trade dates, bid ask, volume, open interest. That's how many contracts are in the market right now, and implied volatility. All they're giving you is implied vol, right? So all these other metrics you have to calculate yourself. That's what this tool does. So flip back here. We are given the implied vol. That's nice. Thank you very much. Really appreciate that. And the time to expiration. Okay, we have that. But we don't have the delta, theta, Vega, but we need that to understand which of these options contracts, both puts and calls, are going to be moving the most, which are the most volatile, and which are going to have the largest payoff, right? So that's why I'm calculating these. Over here, we have time to expiration, implied volatility. We have delta, theta, and Vega, okay? And we have everything for the puts and the calls. So everything looks fine over here. And in my notes, I just have some explanation because this is very important. Just what the terminology is. The strike price is the price of the option. Okay, so if the call is in the money or if the put is in the money, you're going to make money on this thing, right? If it's out of the money, then you're not making any money, but it could go into the money, but there's no guarantee of that, right? So the closer it is to at the money, it's called at the money, or if it's just in the money or just out of the money, you have a good chance to make some profit. If it's way in the money, deep in the money, you're guaranteed profit. If it's far out of the money, you're almost guaranteed no profit unless the underlying stock moves very rapidly. It becomes very volatile and there's a lot of trading. Otherwise, if you're deep in the money, you're all set. Your profit is basically guaranteed. Almost, there's such thing as a guarantee in finance. There really isn't. If it's far out of the money, you probably are guaranteed not to make anything. But again, like in the financial markets, like anything is possible. There's really no guarantee of anything. But so anyways, back to this. So the strike price is the price of the option, the price at which the holder of the option can buy. The last price is the last traded price. We saw that for Microsoft. It was like 337 or something, 387. Okay, 387. The implied volatility is the volatility of the option. This reflects the market's expectations of how volatile the stock will be in the future. Okay, higher implied volatility means greater potential for a payoff. Okay, so if you have a stock that barely moves and you're out of the money, you're not going to make anything on that, right? If there's a lot of volatility and it moves up and down quickly, you can easily make money on that. And the nice thing with these options contracts is if it goes deep into the money very quickly, you can exercise the contract and walk away, right? You can make your profit and then get out of the market and basically lock in your profit, right? For some of these options, I think they're called European options, you have to hold it until the end. There is no early contract. There is no early selling of the contract, of the options contract, right? So delta measures the sensitivity of the option price to the price movements of the underlying assets. So again, remember, these options are written on stocks. You don't own the stock, you own the option. And by the way, if the stock pays a dividend, you're not entitled to that dividend. The stock owner gets the dividend. The option owner gets no dividend whatsoever because you don't actually own the asset. You own a contract, and that's it. But you don't own the assets. Okay, and the delta measures the price movements relative to the underlying assets. So how sensitive the option is. Theta represents the rate of time decay. Remember, these are always going to mature. We saw some are going to mature on Friday, right? Here's the maturity date or the, what's it called, expiration date. So here's Friday, that's in a couple days. That's the following Friday, so that's next week. So the theta is always decreasing over time because all of these contracts are going to expire in some amount of time, whatever it's written for. It could be long term, it could be several months, it could be, I think, up to 9 months. I think they can go up to 9 months. A lot of these are really shorter in duration. It could be uh, 1, 2 months, 3 months, but you could have some long-term options too, right? So, anyways, the theta is the time element and the decay of the options value to you as the option holder, and Vega measures the sensitivity of the options price to changes in the volatility of the underlying asset. Okay, so remember I said a short time ago this gets kind of complicated. Well, I wasn't kidding about that. It gets pretty complicated. So, anyways, we did all of the calculations over here to get implied volatility, delta, theta, and Vega, right? So that is very important to actually pricing of the option and understanding how valuable or how not valuable these are. So let me go ahead and run this and plot the results just so we can visualize it. I always say a picture is worth 1,000 words, right? When we look at this over here, this delta, this theta, this Vega, does that mean anything to you when you look at that? When you look at this over here, does that mean anything to you? It doesn't mean anything to me. So I have to go ahead and chart it. And when I can visually see what the Vega Theta and Vega Theta and what else I did for Delta and then the implied volatility look like, then it makes a lot more sense to me. Okay, if I just look at the numbers, it doesn't make a ton of sense. I mean, I kind of understand basically what's going on, but I think the point is it's always nice to plot these visually so you can see what it looks like on the X and Y axis. And I like these plotly charts. You can zoom in, you can zoom out, you can see all the details. So you have the strike price, the implied volatility, and the delta is what we're plotting here. Okay, so these 4 plots represent, a little bit slow, represent the implied volatility. Okay, that's what's measured on the y-axis, and the strike is always on the x-axis. In this example, you could do this a number of different ways. I think this one makes sense, but there's a bunch of different things that you can plot. It's really up to you. Okay, so it's pretty dynamic how you create your charts and how you share that with your team or your stakeholders or whatever you're doing. So I'm looking at implied volatility, delta, theta, and Vega. That's what these plots represent. Okay, so basically we can see what the strike price is relative to the implied volatility. The delta is the second chart, the theta is the third chart, and then the fourth is the Vega. Okay, and again, I define all these over here. If you don't understand all the terminology, that's fine. Just do some research, Google it. It's very interesting to study this and to arm yourself with this information. And when you really understand it, you can make some pretty decent money in the market. Or again, this way to look at that as a profit motive or as a type of insurance to protect yourself if you own Microsoft stock and you think that there's going to be a quick sell-off due to some market event or whatever, but it's just temporary, then you might buy some puts to protect yourself if you don't want to sell all of your Microsoft shares, right? And then obviously like calls, if you think there's going to be a big bump in the stock price due to some kind of event at Microsoft or maybe some event overseas or Microsoft, I don't know, Microsoft is coming out with a new product or Azure, and you think that there's going to be a short bump in the stock price, then you would buy a call, right? So there's all the plotting, and we got the Greeks. So we have the delta, theta, Vega done. So this is good progress. Let's move down here. The next step, I think, is my personal favorite. I think this is probably the coolest part of the whole analysis right here. Now we're going to estimate the payoff, and we're going to use the Black-Scholes model and the assumption that stock prices follow a log normal distribution. This is pretty well known in the stock market. This means the probability of a stock reaching a certain strike price at expiration. Remember, the next one is going to be in 2 days. That is March 21st. And then the next one after that is March 28th. That's the expiration date. This can be approximated using a cumulative normal distribution. Okay, so this is how we actually get the probability of the option ending in the money. So I abbreviated ITM, in the money. You want to be in the money, whether it's a call or put. Call's going to go up, puts are, you want it to go down. So we can estimate the probability of the stock going into the money because that is not given to us, right? If you look back at the source data, we have implied volatility, open interest, things like that, but has no information whatsoever about oh, it is telling you in the money, okay? So by the blue lines over here, everything is highlighted blue is in the money, okay? and everything that's white is not in the money. So this is the call side. If we go down here to the puts, it's going to be the opposite, right? So all these puts in blue are in the money down here, but you don't have the probability of that option being in the money. So this metric I think is very useful. This is 1.0 in the money, because this is literally in the money. But then sometimes it's not going to be 1.0, right? Like if it's close to the call price or the put price, it could go into the money very quickly, right? If the stock price depreciates, these puts will go into the money, or these will go into the money because it's out right now, but it could easily go in. These could easily slide in. And on the call side, if it goes up, these calls are out of the money, but these could easily go into the money within the next couple of days. Probably not on a contract that's going to expire in 2 days, but for the longer term contracts, that could easily go into the money. So this actually calculates the probability of that event occurring. And then the next thing that I'm doing is calculating the expected profit and loss. So P&L is profit and loss. And we want to know, based on all this analysis that we did on the whole universe of puts and calls, what is the expected overall P&L, right? So we have that calculated as well. So let me go ahead and refresh that and show you what the view looks like. And get some water while this thing runs. Ah, love ice water. Love it. Okay, so the options chain is a little bit big, and the computer is running extremely slow here. I just noticed my Excel finally popped up. How long did that take? Finally got that. Okay, now I don't even need it anymore. That's nice. But in the end, we get a nice summary of the strike price, the last trading price for the option, the implied volatility, the delta, theta, vega. These are the Greeks, the probability of this option contract going into the money, and then the expected P and L. So there you go, guys. You're welcome. These are the top 5 options right here in the whole call universe. And if I wanted to get the worst 5, I mean, I don't think you want to see the worst, right? Because these are going to be all losers. But if we look at the tail of the data, we can look at the worst. Kind of a moot exercise. And there you go. So the expected P&L is you're going to lose everything. And the probability of going into money it's actually not 0, but it's pretty low. These are pretty low down here, low, 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 low. So you want to focus on these that have the higher payoff. This has a 21 times payout, and it's a little bit complicated. I'll tell you in a minute just how that works. But this is guaranteed loser, 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 loser. These are all the winners, right? And you have the top 5. Honestly, this is just the best one. All you need is one contract. You don't have to mess around with 2, 3, and 4. I guess you can if you want, but really this is the number one. This is the only one you need. And I'm not giving you investment advice, okay? So if you buy options and you lose money, please don't come to me and try to sue me. This is not investment advice whatsoever. I'm just explaining mathematically how this stuff works, okay? So I've traded options before and I made a ton, and I've traded options on some occasions and I've lost a ton, right? So it goes both ways. You can make money, you can lose money. You have to be careful with this stuff. And this is not investment advice. Again, I'm just telling you how the math works, how the statistics works, how the finance works. I'm telling you about the terminology. That's it. I'm just giving you facts and information. I'm not giving you any investment advice. Okay. But if you want to know which is the best contract, that's the one right there. Okay. So how do you actually convert this into a profit? Because is that $21? Is it 21 times? It's actually not really either one. You have to do a little bit of mathematics, additional math on this, because this stuff is like kind of from another planet. All these option stuff is very interesting, but it's not really normal finance. So it's just handled differently. The behavior is very different from like corporate finance or structured finance or something like that. So how do you get the probability in the money, first of all? Because there's 2 steps we did at the end, right? We got the Greeks right here, delta, theta, vega. So we calculated that, and a prior step just above with the other script above this. And the last part of this was the probability of the option going into the money. You can see here for these calls, it's basically 0. For these calls over here, it's 100%. And the expected profit and loss, basically the in the money calculation represents the probability of an option being in the money, okay, ITM, at expiration based on the Black-Scholes model, Okay, so we need a couple pieces for this. Again, if you go back, this is really like the logic comes from here. This is the basis for this whole thing. Okay, you have to look closely. You have a D1 variable here and a D2 variable. Okay, so it's all part of this equation. So based on that, the D2 is calculated as part of the Black-Scholes formula, and it represents a number of standard deviations that a strike price exists away from the current strike price, okay? Adjusted for the time to expiration and the volatility of the stock. So this stuff gets a little bit complicated, okay? But stick with me. I think we're getting up to the end of this thing pretty soon, and it's going to be worth it, I can promise. So the cumulative normal distribution, okay, which we're calculating above, this is the norm dot CDF of variable V2 gives the probability of the standard normal random variable will be less than D2 for a call option, okay? So that's how we're getting the probability of a stock option contract going into the money. Here's more of the math, okay? So you could take that and study that. That's going to match what I showed you in the source data initially when I started the video. And then based on that, the expected profit and loss is calculated based on the probability of the option expiring in the money. Okay, so that should be pretty clear at this point in the video. I think we beat that horse to death. Given the intrinsic value at expiration and the option price. So this is how you do the conversion. If you have $10,000, you look at the last price, okay, the option price for the first contract. So in this case, we have a strike of $377.50. Oh, you know what? This moved a little bit because these are dynamic, right? And the prices of the options are changing all day long. So I ran this earlier in the afternoon. Microsoft stock moved up just a little bit. So when I ran it before I went for a jog, this was the number one best contract. It changed just a little bit. So now this one is actually the number one best contract. When I ran it previous, it was 335. So that's a different contract. And then, so that's what I'm looking at down here. So the first contract is the strike price of 335. Okay, so that's what I'm looking at. I'm looking at this contract right here. That earlier today was number one. Now it's number two. This one is number one. And it's $46.80, right? So that's how much it costs. That was the last trading price. So you would take that. You would get you can buy the 10,000. No, wait. I lost my train of thought just for a minute. Let me expand this. 2.36 times 80 times 1 times 10,000. Let me see. Each contract each options contract represents 100 shares, and you would have to multiply the 4680 by 100. Oh yeah, that's it. So 4680 times 100 would be 4,680 divided by 10,000. So I think, let me get this calculator going. I think you could buy 2.1 contracts. 1 second. I'll just use Excel now. That's working. Let me use that. Okay, so 4680 was the price of the contract. Okay, and we have to multiply by 100 because every contract covers 100 shares, right? So let me see, 4680. All right, 46.80. That is the cost of the contract, right? Times 100 divided by 10,000. If we do this, okay, that divided by that times that. 2.13, yes. Okay, so I got the number. That's what I'm looking for. So 10,000 divided by 4680 times 100, because 100, one contract covers 100 shares, you get 2.13. 2.13 contracts. And the expected profit and loss for this contract is 7.18. Okay, so we calculated that. Oh, it's actually different now. It's actually different. 13.3. So these things are dynamic and volatile, and it's going to change constantly throughout the day. So when I ran it in the afternoon, I did this calculation. Probably shouldn't have pulled new data, but that's fine. You just have to understand the concept, right? So it's 10,000 divided by 4680 times 100. The expected profit and loss was 7.18. So before I went for a run to get some exercise today, the P&L was actually less, than it increased a little bit, but this one actually increased faster because this actually became number one. Earlier in the day, this was the number one contract. So let's say hypothetically, the P&L for this contract is 7.18. So the expected profit would be 7.18 times 2 times 100 because it covers each options contract covers 100 shares. So the profit is $1,436.38. There you go. So it's complex, it's convoluted, it's not simple, but I think the stuff is very interesting. And if you really understand it and really master it, you can make nice return trading options. And I'm giving you all the metrics here, and a nice tool to do all the pricing and the valuation, and then to find the best call contract is right there, 337.5. If we go back here and look for this, where's my 337.5? Let me try to find that. 337.5. I was probably going to find a bunch because it's going to have IDs and all kinds of things. Let me just scroll down here. 337.5. Oh, was that it? Let me see. I see a 335. I don't even see that one right now, but this would be the contract that we're looking at. 337. So that's the best in the whole bunch right there. Okay, based on all the analytics and all the metrics that we did. And then these would be the worst down here. And then I redid everything for the puts. Oh, I have one more chart down here I can show you. This is the payoff chart for all the calls that we're looking at, everything in the whole data frame that we pulled in from Yahoo Finance. Okay, so when we plot it, you'll see the payoff. For the calls, it's not gonna give you some huge payoffs. To break even line is right here, right? You have this 21.86, and then the next best one would be over here, 13.33. So I have a 21.86. That would be this guy right here, right? And the 13.33 would be this guy right here. So that is the second best. Okay, so that's represented here. And then most of these are basically worthless. And the reason for that is the option has almost fully decayed. It only has like one full day of trading, and then I think a half of a day. I think these things finish off on the expiration date, like midway through the day or something. I don't even think it goes until the end of the day. So you have one full trading day. So not too many opportunities here, unless Microsoft shoots up when the market opens at 9:30 tomorrow. You don't have too many opportunities to make profit, just like little tiny crumbs over here. And on the put side, I did everything the same for the puts. The math is very similar, slightly different, because you want the put contracts to expect the stock to decrease in value, right? So it's going to depreciate. That's how you make money on a put. If you're long, again, if you're short a put, then it's the opposite, right? So here's the Microsoft current price, 37.82. We see that over here, 37.82. So when we make this call to, I don't want to use like a call and a put, like a call to call. When we go fetch this data from Yahoo Finance, we get the same information right here, right? Because it's coming from the same source, 387.2. You can tell these are puts. This is the P over here, right? So those are puts. You saw the C embedded in the contract symbol or the identifier for the contract. So I can run that and then get the implied or the probability of the stock going into the money, and then the expected profit and loss for these puts, right? And this is the head and this is the tail. So I rerun that, we'll see the top and the bottom of the data frame with the probability of the put in the money, and then the expected P&L, we see that, and then down here we have another chart showing you the same that we saw on the call side too. Okay, so here the puts have a few more opportunities to be in the money. We saw 74.35, and you have to do this conversion over here that I showed you before, right? So if you have, or I'm sorry, that would be the that would be the profit, right? You'd have to take the put sale price, this over here, so 86.75, and this would be the best contract right here. So 540. If we go look at puts, 540 should be down here, and the put territory 540 right there. Okay, so that's going to be the best one right there. And again, these things are very dynamic, changing constantly throughout the day as the underlying stock price changes. So just be aware of that. It's a fast moving sort of beast here, right? But I think, again, very fascinating, very interesting. And if you can really master this stuff, you can make a nice profit by trading options. And some people make a career of this, and they have very good income. Okay, so that is it. That's how to analyze stock options and to pick the best put and the best call on the whole what is it called, the stock on the whole put and call. It's called options chain. So that's how to find the best put and the best call in the entire options chain universe for Microsoft. Okay, so I'm going to go ahead and download this code and share it with you guys. I'm going to wrap up the video, and I'll see you in the next one. Bye.